Hey everyone, thank you for coming over to the other side of the world and making that trek. We are here for the alternative track to talk about the operator-focused ETA models. And I'll just turn it right over to our moderator, Alex Hodgkin, to kick us off.
Hey guys, I'm the Senior Advisor of ETA at Booth, and welcome to our alternative operator-focused ETA models. We're kind of a big growth area at Booth, and we'll be talking about different mechanisms and paths to realize an ETA career. I'm going to start off by, first of all, welcoming our sponsor, Intrinsic. Intrinsic does valuation and financial due diligence work. They do very good work. As a co-founder, I can attest to that. So thank you, Intrinsic. Now I'll let our panelists kind of introduce themselves, their firms and their backgrounds, and then we'll get into some questions, and then we'll have some Q&A after that. So with that, Marc?
Sure. Hi, I'm Marc Van Tricht. I'm with EarlyBirdCapital. We are the inventors of the SPAC structure. I spent about 20 years on the buy side prior to my pivot to banking, so I really approach the whole SPAC process as one that's designed to create interesting investment opportunities for the buy side as well. So hopefully you'll find that perspective useful.
Great. Thanks, Marc.
So I'm Dan Phelps, founder of Salt Creek Capital. We're located out in the San Francisco Bay Area, and our focus is acquiring lower middle market companies in partnership with operating executives. So typically these are folks with 20 to 40 years experience, and we jointly get them involved in our sourcing efforts and pursue opportunities where they would become CEO upon day one of our acquisition. Typically, they're $1.5 to $5 million EBITDA businesses, so certainly lower middle market companies, and it's often a retiring owner, but there may be a number of reasons why a business requires new leadership. And so we want to be that solution that provides not only liquidity to the seller, but also a solution in terms of what succession is required. And again, that's through our executive partner program.
Yeah, Mary. Yeah, go ahead, Mary.
Mary Josephs. I'm a Booth alum and an entrepreneur. I founded a boutique middle market investment bank called Verit Advisors 10 years ago. We focus in the employee ownership or ESOP space. Is the mic okay? Okay. And so it's interesting sitting here next to you, because the ESOP is a really interesting liquidity strategy, but it's not a leadership strategy. And so when Alex and I were talking, we thought it's really interesting overlap with what ETA is doing. And I'm excited to continue the conversation. And thank you.
Sure. Welcome. Thanks.
I'm Jonathan Rogers. We'll see whether or not my mic works.
On and off.
Yeah, we'll see. We may just be taking turns going up to the little presentation stand.
Or just take them off. I mean,
all right. So my name is Jonathan Rogers. I was a Booth alum from 2012. I think I'm the alternative to the alternative operators model, which is I went into an existing organization that had 6 owners that were over 55 and became in charge of the operations, took over that organization, negotiated a deal to where I had equity for an outsourcing solution that I would help build, as well as an acquisition solution that I would help build that would be alongside that operating business, and have since helped with a number of acquisitions in the wealth management space within our organization, and also facilitating the operator side, the operations of those businesses, so that the individual taking over the practice didn't necessarily have to have all of the depth of experience within the industry that we have.
Great, thank you. So if I'm thinking about doing, becoming an operator through an acquisition type of structure, Jonathan, and what kind of opportunity would you present through your platform, or maybe someone could mimic that sort of infrastructure or approach in another industry or vertical?
Sure. So for ours, it's a services business. A lot of the revenue ultimately goes to the financial advisors involved in the company. And so a lot of the deal structure is financed through cash flows. There's a certain amount of debt that often helps to facilitate the initial buy-in. But what we do is we basically help that process go through. So if it's a 3 times multiple over 7 years and 50% needs to be upfront, it's how do you and who will provide the financing for the upfront part of that deal? Who will help to operate that business on an ongoing basis as the financial advisor, as the taking over from the founder, the relationships, which is within a services business, a big part of the intellectual property is actually just the relationships, and so the transition of those relationships, the transition of the operations, and then the financing that underpins all of that transition.
Yeah. Yeah. Do you guys want to come up? I mean, perhaps we take these off. Yeah, appreciate that.
If we talk loudly up here,
Yeah. Yeah, let's do that.
So Jonathan, anyways, it sounded like in our frameworks, you provide, sort of liquidity and succession solutions for folks that are in the RIA space, right? And you've got a platform where you can provide those personnel and structures of capital to facilitate that. Does that sound accurate?
Yeah, and so Dan and I were talking earlier, and it sounds like we have a lot of commonality on the platform in that you have a large number of baby boomer generation owners.
Yep.
And you have talent that isn't necessarily ready to take over all of the operations. And so there's firms that kind of help to bridge that gap, whether it be an investment banking firm, whether it be an operator like our company.
Yep.
A lot of that knowledge about the industry or about the financing deal structure is something that you can pick up on your own. And so like I've done within my organization is basically creating that deal structure out of a small organization where I didn't have a lot of equity that I took in the actual existing operations. So we built an equity opportunity with new ventures within that organization, and then we're helping the next generation of advisors recruit those in and provide capital to those to purchase the businesses of the original generation partners. So there's a lot going on in terms of the pieces, getting the people, the technology, the financing in place at the same time for those people who are looking to succeed out of their businesses over. A lot of times they're not looking for a day one transition. A lot of times they're looking for a 2 to 3 year transition.
Mary, you're one of the leading experts in the nation on ESOPs. I happen to know that. I know we've had a lot of dialogue around this. But how does an ESOP as a tool fit into this ETA landscape?
So what am I doing here?
Yes, Mary, what are you doing here?
So I feel strongly that there's 3 opportunities in the ETA landscape. Number 1, how can you find your target? I'm most familiar with what NextGen's doing, yourself and Brian O'Connor, and it's algorithms and massive outreach. It's a numbers game. The individual entrepreneurs are focusing by industry, but it's a lot of sweat equity that goes into finding a target. My bias and my experience would be that as you approach these entrepreneurial targets, whether it's in the dialing for dollars or you're in face-to-face meetings, to the extent that you can be genuinely objective about what they want to do, and I would say use an ESOP as bait. Are you looking for a transition? If you call somebody, this privately held business owner, and say, can I steal your baby? That usually isn't a very good first conversation. And you have all this defensiveness because there's so much psychological affection toward the company. So using the ESOP as a buyer to create a conversation about not paying federal income taxes can, in my experience, accelerate the conversation to finding out exactly what they want. That their kid's not talented, that they don't have succession leadership, that they want to maximize cash at close, ding, 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 that's an opportunity for you. My experience would mirror yours, that a lot of these smaller businesses would benefit from leadership and don't have strong leadership transition, which is where the ETA model is super attractive from my perspective. And ESOPs are such a subset of the whole M&A market that using it in your conversation is going to result in more deals for you, and not necessarily ESOPs. Number 2, there are 7,500 ESOPs. 6,500 at least are lower middle market companies.
As I said earlier, they did the ESOP for a liquidity transition. Now the business owner has all their money out and never developed a bench. There isn't a leader. In 2016 and 17, we sold more ESOP companies than implemented new ESOPs. In my view, ETA could bring a leader into these companies and provide a succession plan that doesn't exist right now. Number 3 would be investing capital in existing ESOP companies, which is sort of a hybrid where you'd have a minority employee ownership perhaps, and ETA would come in and bring in the leadership and the capital that the company needs for growth and to continue to be competitive.
Great, thank you. Okay. Dan, you have a really interesting approach in the sort of the model that you've been utilizing. It seems to be fairly successful. Can you help sort of inform the audience on Salt Creek and how you fit into the ETA landscape?
Yeah, absolutely. Again, I think this theme of a lot of retiring baby boomers and businesses that are coming to market that will need new leadership is exactly the opportunity that we see. And so it's important for us to have a bench of executives who can step in on day one of a business that we acquire. And I would say most of our executives that we're partnering with have 20 to 40 years experience, and they've probably run divisions of larger companies and maybe aspire to be more entrepreneurial, want to invest their own money and be backed by a private equity group and running a smaller business. And we look at ourselves as a path for those executives, and we typically are working with 10 to 12 at a time, and they've got a range of different industry experiences. We are generalists, and so we'll invest in manufacturing companies. We've done food and healthcare and business services. And so we work very hard to support that executive in our sourcing efforts to expose them to as many deals that fit their background as we possibly can. And we're evaluating essentially deals in tandem, us from the perspective of an investor, and our executive partner as an opportunity to go run that business. Is that a business he would or she would want to relocate to and invest in personally and want to manage and be successful, with much of the upside really being in the equity that they're going to earn as CEO, in addition to their personal capital that they're going to invest. So, we very much look at ourselves competing with search funders, but with more experienced executives in our stable. And because we're often buying from a retiring owner who may be 70 years old, that dynamic of looking at us as presenting a credible candidate who can sit in that founder's chair after retirement and take care of the employees and the customers that he spent his life building, probably spending more time growing his business than raising his family. And so there's a real emotional connection that we look to our executives to try to make and to win a deal. I mean, essentially, we would prefer to win a deal based on the quality of the executive partner that we're backing in that situation than if we were the highest bidder. So all other things being equal, we really want our executive to shine and develop that relationship with the seller. And then once we complete a transaction, we're going to support that executive as board members and strategic support and those types of things throughout the life of the investment. But it's very much driven by our executive partners and the types of companies that we think they can be successful running.
Okay, great, thanks. Marc, I know that you're a subject matter expert on the SPAC mechanism, and that's what your investment bank specializes in. Could you inform the audience a little bit about how a SPAC works and fits into this whole ETA landscape as well?
Sure, and I have to say that for a very simple concept, there's a surprising amount of complexity surrounding it. So I'm going to give you a sort of a thumbnail version, obviously invite you to follow up if you have any questions. The basic concept of a SPAC is that a sponsor team raises capital from the IPO market and puts that capital in trust. They are usually paying about 3% of the capital raised as risk capital, which is what finances raising the money and providing the working capital for the process of finding a transaction. From the investor standpoint, they are buying units in an IPO. Those units have common shares that have a put feature, where they can redeem their shares for the $10 in trust that the unit price costs in the IPO. In addition, there's that warrant value, which essentially provides a yield on providing the bridge equity financing, if you will, from the IPO to the identification and closing of a business combination on the back end. So basically, this is a mechanism with which to acquire a business. I guess what differentiates it against some of the other options that we've heard about is that this is a public vehicle. So it's definitely something for a larger transaction, and it's one for a transaction that benefits from public currency, from growth capital, and from a liquid permanent capital vehicle. So the main consideration to think about from a listing requirement, the smallest SPACs are $40 million. And in order to overcome the dilution in the structure, which comes from the management or the sponsor promote, in exchange for the 3% of risk capital put up, the sponsors own 20% of the basic shares in the SPAC. So in order to offset that, you need a target that is at least 3x the size of the trust. So call it something that's worth at least $150 million. But if you have a business that looks like that, can benefit from growth capital and permanent capital and a liquid public currency with which to retain employees, solve some of the estate planning issues that you've alluded to by creating a mechanism where people can choose their own timeline for exit, then SPAC may be a good solution.
So let's say I'm an exec in the audience, and this sounds like an interesting option for me to consider. What's the criteria by which a management team becomes eligible to raise this kind of capital?
I think the key sort of factors in a SPAC sponsor team are proprietary deal flow. You definitely need to have an idea of where you want to go. SPAC is a very unique solution. It's not appropriate for all transactions. It's relevant to a small percentage of the deal flow out there. Anything that looks like a private equity transaction really doesn't work well in a SPAC for various reasons. So this is really something that is a law of large numbers. In order to find that target that wants to work with you, that makes sense for the public markets, you need to be looking at dozens and dozens of opportunities. So that's first and foremost. Secondly, it certainly helps to have an operator perspective. The investors want to understand that you have the capability to properly diligence the target and potentially provide some strategic input once you do the business combination. Finally, public company experience is also very helpful. Of course, it's not a complete prerequisite.
Great, thanks. Maybe past that. So Dan, I'm an exec in the audience. I like what you said as far as being a potential partner. How would you evaluate that potential executive in terms of bringing them into your circle and working with them in this particular kind of career path?
Yeah, I would say there has to be a certain willingness to be flexible geographically. There has to be a willingness to invest and understanding that it's going to take, on average, a year for us to find a target that we end up closing on and that executive would then become CEO of. We're generalists, and so we're very open to industry background and the type of experience that an executive has, as long as we feel like we can generate the quality deal flow that will support the types of company fits that would work for that executive. Again, I think we're pretty broad in our thinking on that, and open to different industry types, but we have to be confident there's going to be deal flow. The idea of investing a year and not necessarily having anything identifiable is a tricky thing. And there's definitely ups and downs along the way, and so the idea of becoming excited about an opportunity, doing a bunch of work, and then the deal falls apart is a reality that we live in. And for many operators, that's a pretty tough roller coaster to be on. And so just awareness and knowing that there's going to be some ups and downs is part of the challenge. You know, we're a support group essentially, and we are going to provide as much as we can to that executive and provide as much confidence that they're going to close on a deal and complete a transaction. I mean, that's really, we're all motivated toward that goal. And so our view is not only providing sourcing, but do we have the right partners, legal, lenders, Intrinsic to do QE work for us. We're a customer. So all of those pieces that are required to complete a transaction are important aspects of what we want to bring together and provide as much surety for that executive that we're going to complete a transaction at an attractive price, and there will be a successful finish line.
Right, great. Mary, how do I best wield the ESOP tool when I'm in my process and sort of, thinking about, structuring and getting something done and so forth? Yeah.
How do you wield the ESOP tool? It's a little bit like you were saying about SPACs.
Yeah.
It's complicated, but so first, to figure out if someone's interested. I know NextGen has a cheat sheet, which I'm happy to share. Sort of the key big questions you could ask a potential target if you're using it as part of your strategy to find an acquisition. Otherwise, what I would say about ESOPs, and if you Google DOL, Department of Labor and ESOPs, it's a regulated transaction. You want to do it right. So if it's something that is of interest to you, to either buy an ESOP company or use an ESOP as part of the investment strategy into a new co, align yourselves with high caliber advisors. It's not something that you want to play with or you'll have a lot more time with the Department of Labor than you're hoping for. I can assure you a 35-year career in ESOP transactions from lower middle market to multi-billion-dollar companies, we've never had a Department of Labor issue, but it's because we take that process very seriously and we don't overpromise and underdeliver or overstructure. So just be respectful of the guidelines. The tools you have in structuring the ESOP, it has some really nice corporate financial engineering tools. Think of the LBO model with no taxes from the company standpoint, and the business owner who's selling to an ESOP doesn't have to pay capital gains taxes. That can be very interesting, period end, and it is particularly interesting in your great state of California, Dan, yeah. where you add the state tax and the luxury surtax to capital gains. So, either through Alex or myself or NextGen, we can point you to sort of a trusted advisor you could work with to learn and evaluate if it's a strategy that might help your ETA journey.
Yeah, what's the dialogue when the owner says, no thanks, I want to sell to my employees, and you want to open up the conversation, right? And sort of maybe bring in someone like yourself to walk through that process potentially and introduce the concept of if there's a succession issue and you need to bring in someone, how you do that. What should be that initial response when they say, I want to sell to my employees?
If I were in your shoes trying to find a company, I'd be super excited, not because it's going to end up in ESOP, because you have a really strategic dialogue. And bring an ESOP expert or call and get up to speed for the top 5 things, bullet points. Before that meeting, 9 times out of 10, 9.5 statistically out of 10, since only 5% of M&A transactions end up being employee buyouts, as you've used this conversation to create another conversation, you're going to find out that they want to maximize cash at close, or that they don't have leadership, so they can't sell to their employees without selling to you, because you need a leader to run a company. The ESOP's a retirement plan. It doesn't know how to run a company. But it's incredibly strategic to find out what they really want, which puts you in a position to manage your time. It's either an opportunity or it's not. But my hypothesis and my experience is you're going to end up with more deals by having that conversation, Alex.
Jonathan, for the folks folks that are providing capital to you as you execute on your strategy, what's their level of interest? What's the value proposition for them as investors?
So typically the capital, so within our industry, there's kind of two sides of capital. There's either the debt financing and the equity financing. The equity financing, there's a case study out there, HBS has a case study on Savant, not Savant, it's on, shoot. It's on a different company, but I'll follow up with me, I can get you the HBS. Focus Financial, thank you. Nero's my business partner in the audience. So it's on Focus Financial, and I think that's where you look for the equity side, and a great example of the equity side of a transaction if you're an investor. They're typically taking minority positions within an existing operation, having either preferred shares that pay well and then having the next generation ownership vesting into common shares. And so that structure is really well outlined in that kind of a case study. Our structure, really largely our financing comes from the debt side. So we'll debt finance the initial buyout at the beginning. As a company, that's effectively part of how we're trying to encourage next generation leaders to join our company rather than go independent and do an acquisition, is we can provide some of that initial capital. But typically, most owners, it depends on the size of the business as well. So small companies within the wealth management space, when you have a 1 or 2 partner office, those can often be done just with cash flow. Those successors are looking for the right talent, the right person to be able to, like I mentioned earlier, actually take over those client relationships, have good interpersonal skills as well as the financial background, possibly tax or estate backgrounds as well. So they're looking for the person far more than they are the financing. So they're actually often self-financing that through just cash flows over 7 to 10 years. Larger deal structures as you move up to the 100 million, 200 million of assets under management companies and above into that kind of small enterprise model. Those often do involve, one of the sponsors here is Live Oak Bank. Live Oak Bank provides some of the people going in to buy those companies with the debt financing piece. So they're a great resource for if you're looking to take care of the financing piece. A company like Live Oak can provide some of that. But ultimately, I think it's identifying the companies. I think we've reiterated time and again, is the identification of the companies. Is if I'm sitting in your seat, how am I going to actually get out in front of these wealth management firms? There's 18,000 RA firms in the country. The good thing about the wealth management industry is that about, I think it's 42% are over 55 years old of those owners. It's a very rich market in terms of need for succession. And so much of it is, as opposed to the financing problem, the people problem, the individuals are the scarce resource. So as either somebody coming out of University of Chicago or someone out of Kellogg or out of any of the other universities as an MBA with a bit of a background prior to the MBA in either a finance area, investments area, that can be hugely attractive from a human capital perspective to these people. So it's more about creating the list, doing it local geography based if that's what matters to you, do it investment philosophy based. For us, it's Dimensional Fund Advisors and Vanguard. We just target that third of the industry and so that our operations are very efficient. So is it investment philosophy that matters to you? Because there's a few things that matter to the acquirers. You got to figure out what those are.
Great. Mary, what would an ESOP ETA deal look like from an investor perspective? How would that be structured?
Sure, I was thinking about how the capital stacks as you were talking. You know, show me the money, right? So similar to.
There's folks in the audience who might be interested in these types of structures incorporate ESOP mechanisms, and it would be good for them to maybe understand, at least on a superficial level, how those would be structured.
So similar to what Dan had mentioned earlier, you know, a company that is excited about an ESOP alternative at some point has an affinity, a psychological bond to their workforce. The idea that their workforce would be able to keep their jobs, the company can grow, and the workforce can participate in the continued growth of the company in their retirement account really speaks to that entrepreneur and founder's heart. So how does the capital stack up? Similar, you start with senior debt. There's scores of banks around the country who have specialized ESOP lending practices. Usually in lower middle market, it's asset-based. You get a little extra in the ESOP world if you dig down to fixed charge coverage ratios, because the company doesn't pay taxes. So sometimes you can have a little more senior debt. Where does the equity come from, the mezz and the equity, or the mequity? The most easy way to explain this is structured equity. So what the equity from the sponsor of the executive, instead of putting in straight equity, they typically would put in a subordinated note with warrants. And the IRR on that note would match the required IRR of the investor. How? Well, you now have a debt with an equity return instrument in a company that doesn't pay taxes. So in the first 10 years, very similar to private equity, you have an accelerated return from the repayment of debt and the growth of the company. There are private equity firms that specialize in these types of investment in ESOP companies. There's a growth in social capital interest and funds that are forming around that conversation to invest in ESOP companies, but they need leaders.
Great, thanks. Dan, I know that your approach is sort of an open architecture type of ETA approach. Maybe can you give a few examples of how the capital stack has lined up, and you know, to folks that are interested maybe in situations that you find yourself in, how they could fit in and what the value proposition might be?
Yeah, absolutely. So we do not have a committed fund. Each one of our deals, as Alex mentioned, is kind of a standalone basis. So when we find a company that we're partnering with an executive to acquire, you know, we're going to look at what the optimal structure is. That may be more traditional senior debt and equity, maybe senior mezz, and maybe there's a strip of a seller note and some equity in there. But for our investors, from the equity perspective, that's made up, and I should calibrate and say that we're typically talking about transactions that are $10 to $20 million, so smaller than the SPAC world, certainly, but deals where the executive's equity plus the equity that my partners and I are putting in the deal are essentially the cornerstone of the equity that will go into the deal. We have a group of investors that we've worked with over now are almost 30 transactions that are high net worths and family offices that will essentially speak for the rest of the equity. But you know, those relationships with senior lenders, mezzanine lenders are also important parts, and frankly, now they've gotten to know our structure and our approach, you know, what our investor base looks like. That's made life easier. But you know, that's essentially the $10 million transaction is going to be more the senior and equity, and for those larger transactions is where we may use some mezz.
Great, thank you. Marc, what's the investor? You know, who are the folks that invest in SPACs? Are these you know, institutional funds? Are they individuals? Are they going through retail channels? Is it all the above? How are they learning about them? You know, you know, how are they researching them? What's the value proposition? So on and so forth.
Sure. I guess the value proposition from the sponsor standpoint, just to get that out of the way, recall I said there's about a 3% investment in risk capital for a 20% stake in the company. So upon successful completion of a SPAC transaction, sponsors should be able to make something on the order of a 6+ type return on the risk capital. So, you know, very attractive use of time from a sponsor's perspective. On the investor side, the people who invest in the IPOs, again, I think of it as providing bridge equity financing in return for a yield. So it is actually still a niche area of investment. There are probably 50 or so accounts that regularly participate. They tend to be institutional investors that have backgrounds in merger arbitrage, convertible arbitrage, high yield debt securities, anything that, you know, sort of crosses the equity and the yield line a little bit. More importantly, on the business combination side, once there is a fundamental business that has been identified and is being rolled into the SPAC, there's a transition of the shareholder base into fundamental accounts that appreciate the business. So you sort of have more small cap, generalist event-driven investors initially, and then over time transitioning to the vanilla, you know, Fidelities of the world.
Great, thank you. I think we're going to open it up now to Q&A. have an interest in posing questions to our panelists or myself, we're happy to answer. No questions. All right, yes.
This is for Marc. You mentioned in the SPAC pool of capital that's in trust that it has a put feature. How does that come into play at the time a target is identified?
Absolutely. So the put feature allows the investors to redeem their shares for cash for the original $10 investment plus any accrued interest that would have been generated by the investment of the trust into Treasury securities. So what that means practically is a business combination, the fundamental value of the business should exceed the trust value, right? Because if that's the case, then anybody who doesn't want to participate will have an opportunity to sell at a premium in the open market to investors who want to retain those shares and invest in the fundamental business moving forward. So very much showing value in that business combination in excess of trust is critically important. The other sort of considerations are you can backstop with sort of circling up capital ahead of the announcement of the business combination, so you make sure that you retain enough of that trust capital to close a transaction. Another consideration is as a term, the seller needs to accept some minimum level of cash delivered in the transaction. Obviously, the lower that is versus the trust capital, the easier it will be to complete the transaction effectively. There's been a significant improvement in sophistication around all of this, de-risking of the business combination process, so that right now, sort of post financial crisis, when the structure was a little bit more improved and aligned, closing success rate has been around 90%.
Regarding ESOPs, if you implement them in the ETA strategy, are there any pitfalls or hurdles on an exit as far as when you decide to sell? Will there be any buyers who are not interested in that particular piece of the business?
That's such a great question. Does an ESOP complicate the sale side process? If you ask 10 regular investment bankers, they would say yes. And if you ask 10 sort of, ESOP thumping professionals, they would say not at all. Okay, so the truth is in between. There's been a lot of progress in the sophistication of the ESOP trustee in understanding real-world corporate finance. The first ESOP that we sold in 2007, my colleagues in the ESOP community called me a murderer. We delivered $350 million of cash into the retirement accounts of employee owners in a cyclical industry that was entering some more challenging times. It was a win. So we've made a lot of progress since 2007. As I said, there's a lot more M&A activity in the ESOP space. The reality is it's a consideration in the sales side process. If you have someone on your team who understands how this seller is going to behave and what they can and cannot do, it's not a problem at all. And I can point to scores of transactions that have sold. Where ESOPs get a bad rap on the sales side process is the banker assumes that they behave like a regular company and don't start the conversations with the ESOP trustee and bring forward the particular issues that might be involved in a sale from a retirement plan. So it sounds like kind of a wishy-washy answer. My answer is no if I'm working with you, but there's no issues, but it can be complicated if you don't have the right team around you.
Follow up on the ESOP. So is there a case study or a type of company where it would make sense for an ETA exit to start working through, get patient investors? Is there a net upside if you've got a long enough vision, or does it just so much of the value is going to the employees it's not going to make sense for a structure?
Okay, so can an ETA investor get an appropriate return in a sales side? And the answer is yes. The ESOP is a retirement plan. It's a beneficial owner. It doesn't have a seat on the board and doesn't know how to run your company. So the way the ETA investor is going to get their returns is through either bringing their investment in through an LLC, and the ESOP only owns whatever, 30, 40, 50% of the LLC, or bringing it in through structured equity. Either way, the financial engineering or the security design of the investment has to meet the return requirements of the investor, right? And so the combination of the fair price, the fair return to the ESOP, by the way, it's bringing no capital to the table, so it doesn't need a 15% return, but for the ESOP to grow in value at a fair price, you can still design a transaction that will provide very attractive returns to an investor. Very attractive, like high teens.
Any other questions? Yeah.
On the ESOPs, given the costs involved, what would you say is the minimum efficient transaction size?
In the commercial banking space, what's the minimum transaction size? In the commercial banking world, there used to be a rule of thumb that if it costs more than the tax benefits, it's probably a bad idea. And companies under $3 to $5 million in EBITDA aren't good targets. Now, with that being said, of the 7,500 ESOPs, I'd say 6,000 of them are in your space, Dan, because they don't have any other buyer. So what you have to do is work smart and kind of team up with a group of qualified, high-integrity professionals who can streamline the transaction at a lower cost. And I think that takes like NextGen having experience of doing a bunch of deals so you're not reinventing the wheel every time. At Verit Advisors, we don't work on many transactions under $20 million in value, really under $30 million in value, but we can certainly point you to a group of professionals that I would trust with the integrity and who are a lower cost service provider.
Do you think that creates opportunity in that space, just because there's some inefficiencies there, and that particular sort of perceived barrier to incorporating ESOP in solving that problem?
Well, that's how come you talked me into being on here. I think there's tremendous opportunity in the ETA space, because these lower middle market companies, if you find that one bait, you'll get a non-ESOP deal. But if it ends up being an ESOP deal, you're going to find that business owner who really likes the idea of selling to their employees. It's going to be well priced. The multiples are lower in lower middle market. And so the math's going to work to get a fair return to the employees, and something that the trustee would be excited about, create retirement assets for the employees, and something you'd be interested in from an investment return perspective.
I've also heard a lot of conversations around issues related to liquidity, and investors in some of these lower middle market companies, thinking about how they achieve liquidity, whether it be a dividend recap or some kind of buyback or something where it's not the ultimate sale, but there's some incremental sort of mechanism there, and an ESOP is a very tax efficient mechanism by which people can achieve that. Would you agree with that statement?
Yeah, I totally agree with that statement, and an ESOP can beat a private equity investor all day long, but the challenge is capital, right? And an ETA as a strategy solves one of the biggest roadblocks or impediments to an ESOP strategy.
Yeah.
I have a question for Dan. You mentioned during your remarks that you don't have a fund, it's a deal by deal structure. How does that impact the experience and search you would have with your firm?
So I think the big issue when competing for a business, so if we're putting an offer in, there's a process going on with an investment bank representing a company. Easy for that investment banker to go to our website and see that we've completed almost 30 transactions, and providing some credential to that executive, really helping provide comfort that we're going to close a transaction is a big part of our involvement. And while we don't have a fund, and that may be a question that an investment bank asks about us, I think being able to demonstrate that track record at this point has really gotten us beyond that. you know, it's kind of funny, the first 5 or so transactions, the equity raising process was long and drawn out. The last 10, it hasn't been the case. We end up being oversubscribed pretty substantially in a very short period of time. So typically when we get to the point where we've arranged credit, we've done all of our due diligence, legal docs are largely negotiated, it maybe takes us a week of circulating a memo to our investors and bringing in that remaining equity component required to close. So early in our process, it was a bigger issue. At this point, it's largely become a who gets what allocation question.
Thank you.
Sure.
Just to follow up on that point, I think when you mentioned the capital stack, you talked about the debt, and then you guys raised some equity and also some executive equity. Do you also have solutions where the executive doesn't put in equity?
We don't, and I think we, as a firm, just have a strong feeling about aligning interests. And so with our executives, we like the idea that they're making a pretty big commitment, both investing, relocating to where the business is, you know, essentially signing up for 5 years or so to operate that business. You know, we're putting our equity alongside that executive, and he's buying in essentially at the same terms as we are. So we really like that alignment of interest that the executive investing personally provides.
Okay, thanks everybody. We've just hit time, so thanks everybody for coming out. I appreciate it. Hope you found this panel informative, and enjoy the rest of the conference.